Hello viewers, we will be going over the S&P 500 ETF ticker symbol SPY. In this video, we'll be going over the day-by-day probability model, how we find the models, and the forecast model for the S&P 500. So back to the technical analysis. Today we're down 26 basis points on the 1-hour chart. We are starting to approach negative MACD, and we also see a convergence in shape on the 4-hour chart. We start to see a divergence on the 4-hour MACD. We were nearing overbought RSI, and we are currently at the 18 moving average on the 4-hour chart. If we expand out to the daily chart, we start to see a convergence in play on the daily MACD, and we bounced off of the 50-day moving average last week on January 31st. So we also made all-time highs this week of $334.19. So that is our immediate resistance for our next coming days. And as for support, the next support that I see will be the 18-day moving average and the 9-day moving averages, which coincides around the price of $328.65. So if we were to move up higher, that price movement is roughly around 13 basis points to the upside, and to the downside it is around 1.4% to the downside. So back to the day-by-day forecast model or day-by-day probability model. As the day progresses, we have a slight favor to the upside with a 53% chance between 0 to 1.7% chance to the upside. On the other hand, we have a 40% chance of the S&P 500 heading down lower between 0 to 1.7% down. On the extreme case, we have a 7% chance of the S&P 500 heading further down, extending negative 1.7% to 3.5% down. Again, this model is now available in the link below, so do check it out. So we'll go day by day, where the S&P 500 will head to the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to, I would say, December 6, 2012 to March 6, 2013. So let me point out why these two charts are similar. So what we have here on the current trend, we average above the middle Bollinger Band at the beginning of the trend pattern, and then we proceeded to take a slight dip below the middle Bollinger Band, and then afterwards we average above the middle Bollinger Band once more, and then we also take another average below the middle Bollinger Band at this instance, and finally once more we touch the upper Bollinger Band right near the end. So we have those points there. So let's examine the trend in question. We start to see a similar pattern here as well, averaging above the middle Bollinger Band at the beginning. Then we proceeded to dip below the dip below the middle Bollinger Band. Next, we also see it average again the above the middle Bollinger Band, and then we see another dip below the middle Bollinger Band, and then finally we see it revert back to the upper Bollinger Band right near the end. So what we have is 1, 2, 3, 4, 5 points. We also have 1, 2, 3, 4, 5 points. So there's a reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was December 6, 2012 to March 6, 2013. Back then, the S&P 500 was up around 86 basis points. So we see that the S&P 500 continues to move on higher. If we move back to the day-by-day probability model, it coincides with this standard deviation in the 53% chance between 0 to 1.7% to the upside. Again, this model is now available in the link below, so do check it out. If you enjoy this content, feel free to like, comment, subscribe, and thank you for watching.